Welcome to this presentation on option theta, a Greek used to measure change in option value with respect to change in time to expiry. Here we'll cover the following areas related to option theta. What is time value / extrinsic value of an option? How does time value of an option change with the strike price? How does time value change with change in time to expiry? What is theta? How does theta measure change in option price with change in time to expiry? That is the mathematical calculation of theta. Change in theta value with change in time to expiry and spot price of the underlying asset. How theta is used in option trade. I am Aninda Datta, the presenter. So let's get started. Now let's examine what exactly is the time value of an option. Time value of an option is its extrinsic value. An option price has two components, that is intrinsic value and extrinsic value. The intrinsic value is the difference between current market price of an option and the strike price. The intrinsic value is zero for out of money and at the money options. The extrinsic value is also called the time value as it measures the difference between market price of an option and its intrinsic value. Now let's see the graph which shows a breakup of the option price into intrinsic value and extrinsic value at various spot prices of the underlying asset. Now as the call option is deep out of money, there is only time value. But as it moves towards at the money, then the time value increases. Here the strike price is 100, so the time value is highest at 100. Now as the option moves towards, as the spot price moves further upwards and the option moves towards being deep in money, the the time value reduces and the intrinsic value increases. The intrinsic value is shown by the blue line, the blue graphs, and the extrinsic value is shown by the green colored sections. The various details of the options are given in the table adjacent to it. As it could be seen that the extrinsic value is in absolute term is highest when the strike price is equal to the spot price, that is at 100. The time value of an option changes with change in spot price, volatility, and time to expiry. Time value, that is extrinsic value of an option, reduces with a reduction in time to expiry provided spot price and implied volatility remain constant. Time value becomes zero on option expiry. Let's examine the graphs of time value reduction with passage of time. In the graphs, the x-axis have been flipped with axis starting with 2 and ending with 0. That is, the time starts with 2 and ends with 0. This is done to better visualize the concept that time value becomes 0 on option expiry. This is the time value reduction of an at the money put option. Here the time value increases at lower rate beyond 0.5 years, so time value reduction rate increases for less than 1 year time to expiry. Now this is the time value of an at the money call option plotted against the time to expiry. Here the time value reduction is more uniform. Now let's examine how does time value get affected by other variables. Time value indicates a probability adjusted premium over the intrinsic value. Time value of in-money option represents the expected additional intrinsic value generated on expiry, attributed to the probability that the option may expire more in money. Time value of an out-of-money option represents the expected intrinsic value generated on expiry, attributable to the probability that the option may expire in money. Time value increases with time to expiry as the probability of the in-money option expiring more in money or out-of-money option expiring in money increases with time. Time value increases with increase in volatility as the probability of the in-money option expiring more in money or out-of-money option expiring in money increases with volatility. Higher the time value, higher is the reduction rate of the time value. Now, option theta is the first order partial derivative of the option price as per Black-Scholes with change in time to expiry. If the spot price and implied volatility do not change, then the intrinsic value remains constant and the extrinsic value / time value only changes with time. Theta is always negative as time value always reduces with time to expiration. Now let's examine the formula of the theta arrived at by partial differentiation of Black-Scholes formula with respect to time to expiry. The formula for theta is different for call and put option. As time to expiry of 1 in Black-Scholes formula represents 1 year, so this theta is formula gives change in option price per 1 year change in time to expiry. To arrive at the theta per trading day, we need to divide this formula by 252. To arrive at the theta per calendar day, we need to divide this formula by 365. Theta is expressed in absolute value and not in percentage. So if you believe that theta sleeps on weekends and holidays, then use 252. Otherwise, use 365 as denominator. The shape of the theta curve plotted against the time to expiry varies a lot depending on spot price versus strike price relationship. Now let's see two graphs which show the relationship of theta with time to expiry for both call and put options. The graphs show the theta of at the money, in money and out of money call and put options against time to expiry. As could be seen from the above graphs that out of money and in money theta curves have flat shapes for both call and put option. However, the theta curve for at the money call and put option shows a sharp increase as time to expiry becomes less than 0.5 years. So for in the money and at the money options, as theta curve is flattish, so the option value for change in expiry time could be predicted using theta only. However, for at the money options, the option value for change in expiry time could not be predicted with just theta, but second order derivative of Black-Scholes method price with respect to expiry time is needed. Now, option price estimation for change in expiry time with theta only is possible where theta curve is flat. Now, let's examine the graph which depicts the theta and call price against time to expiry for an option whose variables are fixed and are given in the attached table. The graph shows the at the money call option price curve with option details mentioned in the adjacent table. Here the theta has been calculated assuming the spot price of the underlying and volatility remain constant. For time to expiry more than 0.4, the theta curve is flat, so option price reduces at constant rate with passage of time. For expiry time less than 0.4, the slope of the theta curve surges, so call option price also shows a sharp decline. The table on the extreme right shows predicting the new call price for a change in time to expiry using only theta. As theta is calculated for 1 year by the formula, so theta for 0.2 years has been calculated in the fourth column. The gap between the actual call price and the predicted call price using theta is given in the last column. It could be seen that the gap is minimal for expiration time more than 0.4 where the theta curve is flat, as shown in the previous slide. However, the gap is higher for expiration time less than 0.4 where the theta curve shows an increasing trend. So for that section, the second term of Taylor series needs to be used for accurate prediction. The theta is highest where spot price is around the strike price when theta is plotted against the underlying spot price. Now let's examine two graphs where the theta of call and put have been plotted against the spot price, assuming the expiry time and the implied volatility remain the constant. As theta is time decay rate of time value oblique extrinsic value, so theta should be highest where time value is highest. Time value is highest around the region where strike price is equal to the spot price. So could be seen from the graphs that theta is highest where the strike price is equal to the spot price. Now, what is the use of theta in option trade and optimizing portfolio? Theta could be the guiding factor in option trade, as option sellers have the main objective of earning the time value of options. Option selling is short extrinsic value strategy and option buying is long extrinsic value strategy. So option traders generally sell at the money options as those have the highest time value and theta. Similarly, option buyers prefer in money and out of money options as those have lower theta. Likewise, option sellers prefer short dated options due to higher theta and buyers prefer long dated options due to lower theta. However, traders need to consider target delta requirements along with time decay in deciding the strike prices and term periods of the options to be traded in. This theta as a Greek is not used in isolation but used in collaboration with vega and delta by the option traders. So this concludes this presentation. Thanks for watching.